Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Last night, the federal Labor government handed down its first budget since winning the election back in May. Budgets are often fairly well telegraphed in advance, and this one was certainly no exception. It seemed to hold very few surprises, with Treasurer Jim Chalmers keen to avoid any major shocks. But it's a budget that has to walk the line between fulfilling election commitments, dealing with the debt from government spending during the pandemic, and helping households cope with a cost of living crisis. And those cost of living challenges were a key focus last night, from soaring electricity prices through to a massive home building package. Gareth Aird is Commonwealth Bank's Head of Australian Economics. Have you had much sleep, Gareth?
Oh, g'day, Sean. No, unfortunately for economists, budget night is never a night where you get a lot of sleep, but it's a pity in some ways that the government doesn't release the budget until 7:30 at night.
I wonder if they'll ever change that. Will they ever become digital?
Oh, look, who knows? I do think government at the time actually liked to make a night of it. And, we saw that again last night.
Yeah. Okay. Before we get into the macro forecast, any major surprises from you out of the budget last night?
Look, not really. And I think that was very much the plan of the government, was not to deliver any surprises. They telegraphed, I think, well in advance what to expect in the budget. They even previewed the economic forecast, which is rare. Normally, you might get some insight into some policies and maybe the fiscal projections, but this time they even leaked the economic forecasts ahead. It was only probably 3 or 4 weeks ago that the Treasurer said, expect a bread and butter budget. They were his words. And I think that's very much what we got last night. The government at the moment does not want to do anything that would put further upward pressure on inflation and, by extension, interest rates. I think they delivered that last night. And it's probably also worth keeping in mind too that we'll get another budget in around 6 months' time. So this isn't the normal full year budget. It's a budget that will be updated in around 6 months' time.
Okay, so let's get on to some of those macroeconomic forecasts. Inflation is the big one at the moment. It's kind of heading towards, or the government thinks it'll head towards 8%, 7.75%, I think, later this year, and then back to 3.5% through the next financial year.
Yeah, look, they've kept their peak in the inflation rate the same as what they produced in the ministerial statement, which is around 7.75%. And I guess we're going to find out in a few hours' time if that forecast is on track, given we get the Q3 CPI out today at 11:30. They have forecast, though, inflation to come down a little bit slower than they previously anticipated. So they have the headline rate as at the middle of next year at 5.75%, and then in the middle of 2024 running at 3.5%. So they haven't actually forecasted to get back to the Reserve Bank's target, or within the target range rather, of 2 to 3% over the next couple of years. I think their forecasts are probably a little bit on the high side as we go through next year. They have said that we're going to get a big lift in electricity prices, but I think they're probably somewhat downplaying the extent to which certain prices won't rise next year and may even fall. And I'm thinking there on the goods side, we saw a huge lift in goods inflation over the past 12 months. And I think as we go through next year with slower global demand, we might find that goods inflation undershoots on their implied profile.
Okay, let's hope so. What about employment? They think that the unemployment rate will rise to 4.5% in the next couple of years. It's still pretty good, though.
Well, it's good relative to pre-pandemic, but it's not good for the 125,000 odd people that will become unemployed on that forecast profile. I've got to say, in terms of the economic forecast, that was probably the one that stood out to me as being a little bit unusual. The current unemployment rate is 3.5%, and the government has forecast it by middle of 2024 to get to 4.5%. So if you back solve how many people that is that would become unemployed, or what kind of increase in unemployment you're looking at, it's around 125,000. And it strikes me as odd that the government would forecast that kind of unemployment rate, because it's also above their estimate of full employment, which they put at around 4.25%. So I would think the government would not want to get the unemployment rate up to that sort of level, which would mean you'd be thinking they'd be having policies that would keep it sort of more anchored at around 4%. So that sort of stood out to me as being a little bit unusual. It is different from the Reserve Bank's forecast. They're expecting the unemployment rate to only get up to 4%. And I think ultimately the Reserve Bank will not want the unemployment rate to get up to that 4.5% level.
Stay with me, Gareth. We'll be back in a minute. I'm speaking to Gareth Aird, Head of Australian Economics at the Commonwealth Bank. Okay, what about economic growth? So 3.25% this financial year, and then a big drop to 1.5% the following financial year.
Yeah, look, those forecasts look pretty reasonable to us. They're not too dissimilar from our economic forecasts. I mean, the economy will absolutely slow simply because we're running at basically maximum capacity. We are able, though, in Australia to still generate reasonably decent economic growth, even if capita outcomes are soft because we have strong population growth and the government has basically put in a 1.4% assumption around population growth. So if you kind of marry up the increase in GDP and you look at population growth assumption, then effectively the government's saying that we're not actually going to be growing in per capita terms as we go through the next fiscal year. So I think those forecasts look broadly okay. Probably a little bit of upside, I think, though, on GDP as we go through next fiscal year. We should remember that these are all kind of on an unchanged policy basis from what the government has announced. But I think there's scope here for the Reserve Bank as we head through the second half of next year and into 2024 to actually ease policy. In other words, take the cash rate lower if it turns out the economy needs some support.
Okay, I kind of wanted to move to what this fiscal policy means for financial markets and then for monetary policy as well. We're talking about a budget deficit coming in at about $37 billion this financial year, much better than the $78 billion forecast back in March, though in the future years it goes back up. How do you think markets will respond to it? And I mean, I'm just interested in diving a little bit deeper in terms of what it means for monetary policy.
Well, the market reaction to the budget when it dropped at 7:30 was very, very muted. And that's what you'd expect given the budget didn't contain any surprises. I think the market was basically expecting a budget that wasn't providing more stimulus into the economy. That's what we got. That's a good thing in the current environment. And we saw over in the United Kingdom 3-4 weeks ago just how wrong things can actually go if the government announces stimulus at a time when you've got elevated inflation and the central bank is trying to drop the rate of inflation down. So I think in that context, it made sense, given what the government produced, for markets to be basically calm when the numbers drop. I mean, the markets aren't too focused on where the fiscal projections are for next year or the year after. I mean, they'll take that underlying cash balance forecast to go from $37 billion to $44 billion with a pinch of salt, because it's very hard to actually forecast this stuff accurately. The market is probably more interested in the policy side of things. And because there was nothing really in there that will put further upward pressure on inflation and by extension rates, the markets basically, I wouldn't say dismissed it, but they weren't perturbed by it at all. And in fact, markets are just going to be very much focused on how the CPI prints today.
Okay, I'll get onto that in a moment. I just want to quickly ask about the housing package which the government outlined last night. Ambitious, perhaps, shall we say?
Yeah, look, ambitious in one sense, but it was a little bit light on detail. And I think the idea of that we build 1 million houses over 5 years as an aspiration, you can kind of backsolve it to say, well, that's going to be implying we're aiming to build 200,000 dwellings a year. And we haven't been running at levels too dissimilar to that for the last few years anyway. So I think really the government is basically saying there, if we're going to run strong population growth, we better make sure we're going to be building enough dwellings for people. Our aim is to build enough dwellings so that we don't have a rental crisis, if you like. And we're going to do what we can and work with the states and other industry bodies to try and ensure that we can actually get that supply into the market. So wasn't really too many details on how that will actually happen, but clearly they've set a target that they'd like to achieve. And that broadly marries up with the fact that they've got a pretty punchy number in there for net overseas migration.
And I'm delighted that we've got another record too, Gareth. It's important to have records.
Absolutely.
Tell me the inflation number. So the third quarter CPI is out in a few hours' time. This is kind of the big one for the economy.
Look, it is. It's the key piece of domestic economic data ahead of the November board meeting. I mean, we're sitting on consensus for both headline and core, and a lot of your listeners will be listening to this after the numbers print. So I hope we're not widely off, but we think it'll come in around 1.6% on the quarter for headline and 1.5% on the core number. That's pretty much in line with the RBA's implied profile. And numbers like that, while strong, certainly wouldn't bring a 50 basis point hike onto the table at the November board meeting. I think it was a big deal that the Reserve Bank slowed the pace of tightening down to 25 basis points in October. That was actually in line with our call at Commonwealth Bank, but it wasn't in line with what the market had priced. So I think in that context, the hurdle to go up to 50 basis points is now very high. the labour market data out last week. It showed that the labour market's tight, but we had a flat unemployment rate and no employment growth. So I think provided we don't get a major shock today, the data today will just greenlight the RBA moving the cash rate up by 25 basis points next week.
Gareth, thank you for talking to Fear and Greed.
It's a pleasure.
That was Gareth Aird, Head of Australian Economics at the Commonwealth Bank. This is the Fear and Greed Daily Interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.